Hey, what's up, everyone? You ever wonder if there's like a secret signal the economy sends out right before things go south? Something that most people totally miss? Well, guess what? There is. And today, we're going to break it down. It's called corporate defaults. Now, I know that sounds super technical, but stick with me. By the end of this, you'll see it's one of the most powerful warning signs out there. Let's dive in.
So, what is this big secret signal? It's not the day-to-day chaos of the stock market, and it's not even those big unemployment numbers you hear on the news, though obviously those are important. Nope, this is something way more fundamental. It's about what happens when a company just runs out of cash and can't pay its bills anymore.
Yep, that's it. A corporate default. It's basically the same thing as you or me missing a mortgage payment or a credit card bill, just on a massive corporate scale. The company promised to pay back a loan, and then they just can't. Now, one company doing this, not a huge deal. But when a whole bunch of them start defaulting all at once, well, that's when you get a really clear, unfiltered look at the economy's real health. Okay, so the best way to think about all of this is to picture a fever chart for the entire economy. It's how we check its temperature and see if it's about to get really sick.
See, when the economy is humming along, corporate defaults are super low. Companies are making money, they're paying their debts, everything's cool. But the second things start to get shaky, you see more and more companies start to miss those payments. That default rate spikes just like a fever. And that spike, that's the big flashing red light that trouble is on the way.
Now here is where it gets really interesting. These defaults, they don't just happen randomly, one here, one there. No way. They come in waves, all clustered together.
And I mean, just look at this timeline. It says it all, right? The spikes in defaults line up perfectly with the biggest economic crises we've seen. You've got the dot-com bust, the 2008 financial meltdown, and of course, the COVID pandemic. That's not a coincidence. When the economy gets sick, a massive wave of defaults follows.
The official term for this is default correlation. But I just call it the domino effect because that's exactly what it looks like. The economy gets rough, one company fails, which means it can't pay its suppliers. So then those suppliers get into trouble and can't pay their suppliers. And pretty soon, the dominoes are just falling one after another. But here's a really important detail. Not all companies are created equal when we talk about risk. We have to draw a clear line in the sand between two big categories: investment grade and non-investment grade.
So think of investment-grade companies as the straight-A students of the corporate world. They're usually bigger, more stable, and seen as very safe bets. They get a credit rating of BBB or higher. Then you have the other side, non-investment grade. These are the riskier players, and their debt is often called high yield or, let's be honest, junk bonds. They get a rating of BB plus or lower. And the difference in risk is it's huge. Look at this. Back in the 2009 crisis, those safe A-student companies had a default rate of less than 0.5%. Tiny. But the riskier, non-investment grade companies, over 9% of them defaulted. That is a massive gap, and it tells you that when the going gets tough, the riskier companies are the first ones to go over the cliff.
Okay, quick but super important point here. There's a difference between a company getting weaker and a company actually defaulting. Credit deterioration is like when you start feeling sick. You're not well, your health is declining, but you're still showing up to work. A credit default is the actual heart attack, the moment you collapse. One almost always leads to the other.
And this all leads us to what I think is the coolest part of this whole thing, how those simple little letter grades from the rating agencies can basically predict the future. It turns out those ratings, the A's and B's and C's, they're not just random letters someone made up. They are built on mountains of historical data, and they are shockingly good at predicting which companies are most likely to fail. A company's credit rating is probably the single best crystal ball you have for its future health. Okay, check this out. For BB-rated companies, the average default rate is basically 0. For B-rated companies, it jumps a bit to around 2%. But look at what happens when you get down to CCC/C. The default rate explodes to almost 27%. That is not a gentle slope, my friends. That is a cliff. And if we just zoom in on one particularly tough year like 2016, the difference gets even crazier. The BB companies, still barely any defaults. The B-rated companies, a few more. And the CC/C crowd, a full 1/3 of them defaulted. Just let that number sink in. 33%. In a single year, 1 out of every 3 of these very risky companies just went under. 1 in 3. This is exactly why those credit ratings matter so much.
So, we've looked at a ton of charts, a ton of numbers. Let's bring it all home and answer the big question. Why should you actually care about any of this?
All right, here's the bottom line. First, remember that defaults are the economy's fever chart. When the temperature goes up, something is wrong. Second, they happen in waves, like dominoes during a recession. Third, that risk gap between safe and risky companies isn't small, it's a canyon. And finally, credit readings are your crystal ball. They tell you who's most likely in trouble. If you get these 4 things, you'll be way ahead of the curve in spotting the next economic storm. And that, of course, brings us to today. We know these default waves are kicked off by major economic shocks. So as you look at everything going on in the world right now, just ask yourself, what could be the trigger for the next wave? And more importantly, now that you know what to look for, will you see it coming? Thanks for watching.